Sorry, thank you, Gemma. Thanks for the introduction. Welcome everybody to today's webinar, Investing in Property Within Your Self-Managed Super Fund. Before we jump into today's webinar, I'm just going to bring up the quick disclaimer. All the advice that we're providing today across our panel here on behalf of Blue Rock is all general in nature. So I'll just give you a quick second just to have a quick look at that disclaimer there. It's on your screen. The panel today, we have George Caravan, who is our head of or director of Blue Rock Self-Managed Super Fund. So there's not much that George doesn't know about self-managed super fund lending in the SISTAC. So welcome today, George. Good to have you here as a panelist. To my left, Lee Fernando, who is the director of Blue Rock Private Wealth. And Lee will be obviously discussing everything to do around legalities around self-managed super funding and investing within.
Thanks, Jamie.
Thank you, Lee. Great to have you on board. And myself, I'm the head of our managing director of Blue Rock Finance. So I'll be discussing everything to do with borrowing within a self-managed super fund today in terms of limited recourse borrowing arrangements. So I'll just quickly jump into the next slide as well. And just for those of you who don't know who Blue Rock are or what we do, so effectively Blue Rock is a multi-facet professional services firm that looks after the needs of both businesses and personal needs. So we have a number of different divisions across Blue Rock which can cater financially for your business. So if you're having a quick look at the slide there, you can see from a business perspective, we deal in grants and incentives. We have our own digital team here in-house, which can help with marketing your business and SEO, etc. Our own law division, which is commercial litigation law, general insurance, bookkeeping, accounting, finance, private wealth, self-managed super fund, philanthropy through our Blue Rock Foundation, and also our SMSF team, which is obviously headed up by George. So that gives you a good insight into what Blue Rock does. We do cater for SME businesses to come into Blue Rock and effectively get everything done under the one roof. So with over 6,000 clients, we feel like we are extremely good at what we do. So I encourage you to obviously come in and deal with any of our directors across our business. All right, without any further ado, I'll jump in and just hand over to Lee Fernando from our Private Wealth Division, who's going to give you an overview around investing in property for self-managed super fund from the private wealth perspective.
Sounds good. Thanks, Jamie. I'm sure everyone can hear me okay. So yeah, I think we've been talking about running this webinar for quite a long time. And George wrote an article probably a year ago or so that had a lot of traffic that people really liked. So when I was kind of introduced to come along to talk about property and self-managed super funds, I was actually a little bit hesitant because, you know, as a financial advisor in the industry, there's been a lot of press and a lot of focus on setting up super funds for the appropriate people, and you know a lot of advisors out there have been setting it up for inappropriate situations. So I really want to focus on that as a bit of a theme to talk about great areas where self-managed super funds and property make a lot of sense, but also really sort of identify some of the areas that where they don't make sense. And I have a lot of conversations with clients about this. I delve into their personal situation in a fair bit of depth, and it's really line ball sometimes whether we should be setting up a super fund or whether we shouldn't. But I would say when we can work out based on their personal situation that a self-managed super fund borrowing money, buying property is appropriate, does make sense. It's honestly one of the best tools out there for growing your wealth in a really smart manner. So that'll be the theme for my discussion. So if we think about different aspects that you really need to qualify yourself to work out if a self-managed super fund is right, we think about the way you need to think as a person, your financial position and a likeness for property. So if I start off at the top there, we look at even by definition the term self-managed sort of identifies that you need to be proactive in nature. You need to, want to be focused on your finances. You need to allocate some time towards that. And like anything, when you're buying a property, instead of just having cash in the bank, there is more focus. There is more need to allocate time towards that. So that said, the self-managing aspect is important. Ultimately, you're a trustee of your own superannuation. So if you compare that to having an industry super fund where it's, what's my login details and, nothing really to do, there's a bit more work in it from a self-managed perspective. But George, I call George the self-managed super fund nerd. He's kind of, I think dedicated most of his life and professional career to self-managed super funds. He has a big team that he looks after. And they really take a lot of the grunt work away from the self-managing aspect. But, to wrap that up, you do need to be sort of proactive in nature if you're considering a self-managed fund. Next there is strong financial position. So, when I talk to people, there might be some inquiries on the website and might talk to, a young person that said they should set up a self-managed super fund. Generally, I can sort of identify within a few minutes that it might not be appropriate because they're not generally, when you're younger, in a really strong financial position. So it doesn't really have to do with age. It's more so around financial position. So I thought we'd just identify a few key aspects there. Might be, a successful professional earning really good income. Might be a business owner with a profitable business with really good cash flow where you can, allocate more money to super is a key one. Maximising contributions, tax deductible contributions are $27,500 for the year. So if there's a couple and, in terms of household income, you can allocate that whole $55,000 into super, really starts to stack up to say, let's start a self-managed super fund, let's borrow money, let's buy a property because we have the ability to push more into, that structure and save tax and grow a property. So that works really well. And then, large super balance is another dot point there. I think that's an important one. This isn't really a set and forget rule and exact here, but the ASIC used to give guidance that you'd want $300,000 as a minimum. Then they raised it to 400, then they raised it to 500, and currently it's around $500,000. So, that's a really good starting point, but I don't think it's an exact amount. I think it's important to delve into personal situations, and in some circumstances, it could make sense to start a self-managed super fund with a much smaller balance, but it really needs to be talked about and worked out because ultimately, running a self-managed super fund, it's more expensive than running an industry super fund, as an example. So working all of those nitty-gritties out is really important before you embark on, self-managed super fund borrowing and property. And then the next part there, and favourable to property, I think people need to be sort of up for that challenge. If you're happy to take on more debt from the bank, you like the idea of property, then doing it within a self-managed super fund can make a lot of sense. All right, now next is tax strategies. So when I'll make a pretty big generalisation here. I would say most people in Australia think about super, set and forget. I can't really touch it for many years. As a financial advisor, I love superannuation because I think of it as a tax structure. And I would say it's probably one of the best tax structures in Australia, where in your personal names, I'm sure people are aware, you pay 19% plus Medicare levy if you don't earn a huge amount of income. You pay 45% plus Medicare, so top marginal tax rate of 47%. That is really important when you're thinking about growing assets in the right way and strategy. Large tax rates there. In superannuation, instead of 47% in your own name, the maximum is 15%. So that's in terms of a tax structure, it's very favourable having assets in superannuation. And then even better, if you're over the age of 60, or 65, depending on a few rules, you can turn a pension on and you can pay zero tax. So that's the bit when I talk about one of the best tax structures in Australia. The ability to pay no capital gains tax, no tax on income when you're in pension phase is a phenomenal opportunity. So
and it's important to note that the 0% tax in pension phase does depend on your pension balance.
Yeah,
there are certain rules around the 1.7 mil of starting pensions, which means that a portion of that could be taxable after.
Yeah, correct. So as long as there's under $3.4 million in pension phase, everything in that balance is tax free, and anything above 3.4 can, incurs 15% tax. So, phenomenal opportunity to, grow wealth in a smart entity is the way that we think about that, and really minimise tax for the future. So if we look down there, future capital gains, I thought I'd just give a really simple example here so a lot of people can understand that. We buy a property for $600,000 at a 7% capital growth rate. After 15 years, that property is worth, 1.65. If we bought that in our personal name, and there was no other income in your personal name, you'd have an assessable gain of $500,000 where you pay, probably hundreds of thousands in tax. Based on your personal situation, you might have other assets and things like that, but there's going to be a lot of tax to pay if you sold that property in your own name. Whereas if it's in superannuation, if it's in pension phase, you've got under the $3.4 million balance, then you pay no capital gains tax on that. So that's a phenomenal opportunity, I would say, to grow wealth in a smart way. And then for business owners, as a financial advisor, there's hundreds of different strategies that I talk to clients about. And I would say, self-managed super fund and buying a property to rent that your business can rent from your own fund is probably one of the best strategies out there that I talk about. When we talk to business owners and that's an opportunity, we really, delve into that to say, even if you've got a small balance now and that's part of the plan, let's have a 5-year plan to start to build superannuation to get enough in there to buy a commercial property and then, rent that from the business. So the business gets a tax deduction there. The rent is received by your own fund, which is tax effective at either 15% or 0% if you're in pension phase. You can control the rental increases because you're your own landlord. There's just huge benefits there. All right, so I thought I'd give 3 examples of client situations that are very practical and hopefully easy for people to understand. So this is the one here that I was just talking about from a business owner perspective. The business, you would want to ensure that it has strong profitability, that it has really good cash flow, because ultimately the business will be paying the rent and the rent needs to be paid to a self-managed super fund to pay off the loan for that commercial property. So a strong, quality business is a really key one there. I just threw a number in there around $500,000 as a starting point to justify commercial property. You might, it might be much higher than that. It might be a much bigger commercial property, might be a $5 million purchase where you obviously need a lot more in there to justify. And then on the other end of the spectrum, there might be a tradie with a couple of staff in the business and they need a small factory, and those numbers will get a lot smaller. So you wouldn't need those big balances to justify getting a small factory to keep some tools and some equipment, things like that. So I think my message there is probably, when there's a business, there's lots of complication, but there's also a lot of opportunity, and it's worthwhile delving into personal situation to work out what needs to happen and how to get there. So next one, this is one of my favorites too, is if we think about some pre-retirees, it could be a bad term, but in financial advice, that's the term we use. They might be in their early 50s. They've got really strong household income. So let's say, both in the top marginal tax rate, anywhere from, $400,000 as a household and upwards. So they've got the ability to save. They've got the ability to, pay down their home loan really quickly. They might have just a little bit of home loan left. They might have finished educating kids privately, which is, usually a big cash flow burden for people. So they've really, you've got this window of time left in their role where they go, great, I've got great earning capacity, got 10 to 15 years left of work. I'm going to do my best here to push a bit harder and grow wealth and really set my retirement up, really supercharge my retirement. So, starting a self-managed super fund, borrowing money, buying a residential property with a really strong capital growth aspect can be a really great strategy for people in, at that sort of stage of life and age. And then the next one, back to the very start when I talked about, sometimes it's appropriate and sometimes it isn't. I just really wanted to talk about an example where I would have a couple of conversations like this. If someone might inquire on the Blue Rock website, I would pick up the phone and have a chat. And this is, a fairly common one, I would say. So hopefully I don't offend anyone here. My wife is a nurse, so nurses and teachers are great people. But generally, if they're younger in their 30s, they don't have huge upside in their income. So it's more statutory, little increases. Unlike a qualified professional or a business owner that can churn out a lot of profit, the income side of things for young families, nurses and teachers is more capped. So they might have heard at a barbecue, hear that example all the time, that their friend has a self-managed super fund and tells them to do it. That doesn't necessarily mean that it's appropriate and they should. They've got a small super balance there, a couple $100,000. Most of their savings will go towards kids' activities, repaying the home loan, things like that. And when push comes to shove, they don't have really strong financial resources to push more into superannuation. So very quickly in a circumstance like that, I'll give them guidance to say, look, I don't think self-managed super fund is appropriate, and an industry super fund can work really well for situations like that.
Thanks, Lee. I think that's done for you. Yeah, we'll pass over to George.
Yep.
Excellent strategies there. Obviously, what's appropriate, when it is appropriate to invest into super property and when not to. So thank you very much. Obviously, the tax advantages of doing so as well. That's very important. So being able to pay no tax later on in life under 3.4, that's probably the most exciting thing about superannuation. Absolutely. I'll pass you over to George now. George, over to you.
Thanks, Jamie, and welcome to everyone that's on today. As Lee mentioned earlier, he calls me the super nerd, and it's quite funny because Lee, being an advisor, is always meeting with clients and trying to figure out what's best for them, and he'll come to me with strategies, and that's where I come in and help and say, okay, Lee, the super rules will allow you to do this, but the super rules won't allow you to do that, which is great because we're using my expertise and his expertise to better service our clients holistically. So in this next section, I'll talk about the options for buying property via an SMSF. Now, it is the most common options. There are a lot more strategies available out there, which we don't have time for today, but obviously more of the complicated versions. So in terms of direct ownership, you can buy the property in an SMSF by paying for it in cash. You can contribute a property into an SMSF if you've got the available cap in your contribution amounts available there. You can buy a property as tenants in common, and that could be with a related or unrelated party. And then the last direct ownership we'll talk about is borrowing via limited recourse borrowing structure, which Jamie will then expand on later on in terms of how the banks lend for that. You can also buy property indirectly via unit trust, and that unit trust could either be related and unrelated. So what I'll do is I'll go through each of these scenarios and explain some of these. Again, if you guys have any questions around these, please put them in the chat box and we'll answer them later on. So before we get into that though, I wanted to talk about the rules around acquiring property in an SMSF. So there are specific rules, especially when it comes to related parties. So with commercial property, an SMSF can purchase a property from either an unrelated party, but it could also purchase a property from a related party of the fund, so long as it satisfies the business real property conditions. And what that is, it generally means that the land and building are used wholly and exclusively in a business. So an example of that would be a cabinet maker who owns a warehouse. He's leasing that to his business, so he owns it personally. He's considering buying that property from himself via his SMSF, and because he is using it in his business, it satisfies that rule, and therefore he can actually sell it to his SMSF. With residential property, it's a little bit different. So an SMSF can buy residential property as an investment, but not from a related party of the fund. So an example of that is if you own an investment property that's residential, say down at the beach, your SMSF can't buy that from you. And then briefly, I guess, the ATO describes related parties of the fund include members of the fund, your relatives, and the associates. We'll just go to the next one, please. So there are rules around leasing as well, and they're different for commercial and residential. So a commercial property can be leased to both related and unrelated parties. If the lease is related, though, it's important that the terms of the lease are commercial and at arm's length to avoid breaching any of the superannuation rules. So an example that is our cabinet maker, if he bought the warehouse from himself and he owned it in his SMSF, he can't go charge $2,000 a month rent if the realistic market value for that property is $1,000. So you've got to deal with yourself at arm's length at all times. Get the next one, please. With leasing residential property, obviously mentioned you can't buy residential property that you own to your SMSF, and you cannot obviously lease it to a related party either. So an example of that is if the SMSF did buy a beach house from an unrelated party and then had it on Airbnb, no related party of the SMSF could rent out the beach house, even though if they paid market rate for it to stay. So no personal use from any related party.
That's probably one of the most common thought processes that comes into clients' minds.
Yeah.
Oh, great, let's go buy a beach house and I'll use it.
Yeah.
So, by definition, you can't use it.
No, we get a lot of inquiries around SMSFs and buying beach houses because everyone wants a beach house, I guess. And the first thing they ask me is if I bought it through my SMSF, can I stay there? And the answer is no. So we'll get into the direct property acquisition example. Now, if you've got enough money in your SMSF and if your advisor says it's a good idea to do this, you could purchase a property outright. It's the simplest form of ownership because you're just paying cash for the property and your SMSF owns it. That means that obviously the rent, when you rent it out, goes into the SMSF, and then the capital growth is held through the fund. It is important to note that the property can never be used to pull equity out. So you can't have it encumbered. That's another common question that we get. If I buy a property in my SMSF and I've paid for it in cash, can I then use the equity to borrow to buy another property or to borrow to buy shares? And one of the rules in superannuation is you cannot have an asset encumbered except for when it's done via the limited recourse borrowing strategy, which we'll talk later on. So this is what it looks like. You've got your SMSF, pays cash for a property, commercial or residential, and then leases it to a tenant. Obviously, if the tenant is related, it can only be for commercial property. Now, Lee, you had
So I thought I'd jump in here and talk about a few different ways to structure a self-managed super fund. So just being really conscious that the reason we're here to talk about is property and self-managed super fund, and generally there should be a lot more to it. So if we look at those buzzwords up the top there, cash flow, liquidity, diversification, all of those things are very relevant. So if we jump into cash buffer, I think relevant for superannuation but relevant for any strategy really. If you're ever thinking about taking on debt to buy a property, then you always want to have a good backup plan. So some cash sitting on the sidelines. If if the tenants can't pay the rent, then how am I going to pay the mortgage? Cash buffer is a key one.
Yeah.
There's a maintenance. Yeah, just curveballs that come into play.
Yep.
So within super, really good cash buffer and really any personal strategy. Then share portfolio. So that's the Blue Rock has a whole nother part of the business that solely focuses on investments and share portfolios. So I'm not going to go into depth around that today. But to have a property debt with a cash buffer supplemented by a really strong share portfolio is a really good way to structure a super fund. If you think of a simple example around a property worth $1 million and a share portfolio worth $1 million, if you need a quick $50,000, $100,000 for whatever reason, you can't sell a bedroom or you can't sell a kitchen. But with a share portfolio, you can sell 5, 10, 20, 100 grand, whatever you need to. So that whole liquidity piece with a share portfolio is a really important one in terms of structuring a self-managed fund. And then alternatives, that's they're probably the more sexy things to do with self-managed super fund that you can't do in any other type of super. Classic cars, quite close to my heart. I looked at that for my super fund a couple of years ago. I was really keen on buying a classic car. I didn't end up doing that, but that's probably on my radar for the future to say when something comes up, I really love to get into that asset class. And classic cars has been a great performing asset class over the last sort of 5 to 10 years. If I could do that with my super, that'd be really cool. Whereas art, as is also in a sort of alternative bucket. I know nothing about art, and I would never look to buy art with my self-managed fund. But, for some people, if you know the art industry really well, you can actually, it's fairly inefficient. You can find bargains. You can get really good returns from investing in art. So, highly encourage you not to do that yourself if you don't know anything about it. But for those that do, that could be a way that super funds are used. And then private equity is another example. There's around Blue Rock, there's lots of opportunities that go around with people raising capital for their business, and we get lots of insights. So, I'll be using my super fund to, put money into a few different private businesses like that, that if my money was in an industry super fund, there's just no option there. So those alternative asset classes is something that can be thought of. It's quite, it's probably more rare, I would say, to invest in those things. The most common would be cash, property, and taking on debt to buy property. That's probably the main reasons of why people start, self-managed super funds.
Do you still recommend a diversified portfolio, like a 33% cash, 33% property, 33% share portfolio?
I think
how you should diversify your self-managed super
fund? You always, in majority of times, you want to have, diversity there. So, different things go up at different times. Jamie, I'm sure you'll talk about interest rates later, interest rates going up. So, all of these things act in different ways at different times. Property going up, property going down, interest rates going up, interest rates going down, share portfolio, dividends versus capital growth, and, having different aspects or instruments within a self-managed super fund is really important. And then the example that I actually want to give there, which is the opposite of what I just said, could be where there's a business owner and they can get just enough together to buy a commercial property. So that's probably where you'd sacrifice the diversification as a starting point, getting to that commercial property, still have a bit of a cash flow buffer, but then over time, then you start to build out the other diversification aspects of the super fund.
Build out your assets.
Yeah. It really depends on the client and their scenario and what they can do, what the plan is.
Yeah, that's like where we would sacrifice all of those things is you can have a smaller super balance. You don't have diversification to get that, small factory or get that, small commercial property. And really as a starting point. So it can't be, that's the plan for the super fund forever. It's like, let's just get that started and then let's put contributions in, pay down the debt, get the rental income and build the other parts of the portfolio. All right, so last one there around property. So this is just, over the journey, spending a lot of time talking about this, working with different property companies. There's just a few commonalities there around, what to do and what not to do. So I would say, never buy apartments off the plan. They don't have much capital growth factor. They pay a bit of income, but, not really appropriate to have in a super fund. I would never in my life advise anyone to, own a apartment in a fund. You don't really want to have house and land packages. There isn't much scarcity factor in those. They don't really go up in value as much as, strong blue chip property with a, good land component that's going to, perform really well over time. And then, another buzzword down the bottom there, negative gearing. I'm sure everyone's heard of it. In negative gearing has its merits. It can be okay in certain circumstances, but mainly when people are in the top marginal tax rate in their personal name. So 47% tax versus, in superannuation, you're only getting 15% back of that, negative gearing aspect. So that's where probably, you either want to have a property in super positively geared or neutrally geared. The negative gearing benefit just isn't there because of those tax rates.
So moving on, buying, or I guess in specie transfer of property to an SMSF. Essentially what that means is you're using the contribution caps that are available to members to make contributions and transfer that property into an SMSF. So if you are currently owning a business real property, in other terms, commercial property, you could, depending on what that property is worth and how many members are in the fund, and noting you can have up to 6 members in a self-managed super fund, using those members' contribution caps to transfer the property in. This is something that you should be getting advice from an advisor. It's tricky. It can be done, but there's a lot of things to be aware of, and that's the contribution caps, dealing at market value and commercial terms with the transfer. Obviously, I mentioned it can only be done with commercial property, so you cannot transfer in residential property that you own. And there may be stamp duty exemptions. depending on the state that you live in, as well as who the beneficial owners of that property are and who are the beneficial members of the SMSF. There would also be capital gains, obviously, if it was a transfer of property from your personal name to a different entity, which is the SMSF. So definitely something that we've advised on before, and in some scenarios it makes sense, in others it does not.
Even there, if you're considering that, and then we identify it's going to cause a capital gain in your personal name or in a family trust or something like that, there's some contribution strategies that you can use if you're planning that over a couple of years to offset a big chunk of that, capital gains tax. So it's always, as a financial advisor, so looking forward over the coming years to say what are the strategies and what are we doing, and how do we. I talk about getting all the ducks in line, so we're really maximising that benefit of property and super and mitigating tax.
Correct. All important about having strategy for everything that you're doing and a plan. Yes, please. So this is just an example, a diagram of what it looks like. John and Jane, they use their non-concessional contribution caps for the 3-year bring forward. Currently, the 3-year bring forward non-concessional caps are $330,000 per member. And they use that cap to transfer property that they personally owned into an SMSF, right? And this was a Victorian example, so there was no stamp duty on the transfer because there was no change of beneficial ownership. There was a capital gain event in their position. However, some personal concessional contributions were used to offset that gain in their world. And as you can see, the SMSF would own the property and then lease it to a tenant. Again, the same rules apply. Related party can only be for commercial property. The next example is buying property as tenants in common. So, for example, your fund could purchase 50% of the property using the fund's cash, and you or another party that could be related or unrelated could purchase the other 50%. And 50% is just an example. It could be 20, 80. It could be 30, 40, 30, more than two tenants in common. Both owners are obviously listed on the property title according to the ownership percentages. It's important to note, though, that the income and expenses need to be split as per the proportionate ownership on the title. So if it's 50-50 and there's an expense to pay, 50% will be paid by the fund and 50% will be paid by the other party. The same with the income. So if it's receiving rent, the rent should be split both ways as well.
Yeah, and then, thinking about strategy, George and I work pretty closely on all of these types of things where I know clients' personal worlds, fairly intricately. George will know the super world quite intricately. And if we can sort of combine the two to get, buy an asset that is much better, much is going to produce more income, is going to go up in value more. The example might be they've got $1 million in super to allocate towards property from a cash perspective, and then in their personal world, they've got the ability to drop $1 million in. Instead of buying a $1 million property in super, they can buy a $2 million property, and 50% of those proceeds can go back into super and 50% into their personal world. So,
yeah, and there's also the example scenario we've had. The clients have money in super, not enough to buy property outright. They don't want to borrow to buy the property, and let's say they've got $500,000. They'll use $250 to buy a $500,000 property with themselves personally, and then use the other $250 to invest and diversify in share portfolios, etc. And therefore, they've got that diversification going on. So in terms of what it looks like, again, the SMSF would own 50% of that property, and the investor, whoever that is, related or unrelated, could own the other 50%. And then you get a tenant, again, because it's got to do with an SMSF, it can only be a related party if it's a commercial property. And so obviously the lease with the SMSF and the rent goes back to the owners as per the ownership percentages, and the expenses are paid in the same proportions as well. Just moving on now to the indirect property acquisition scenarios. The first one we'll talk about is the related party one. So an SMSF can invest cash into a unit trust, which would be established for buying a property. The members of the fund or the related parties also invest in that trust, so it becomes a related party unit trust. It's important to note, though, that in this type of structure, when an SMSF is invested in a trust that it controls, and by control I mean it holds more than 50% of the units, and that's itself, its members and related parties. The superannuation rules specifically state that there cannot be any borrowing in that trust. So I'll give you an example. We might move on to the next slide. We've got John and Jane, members of the SMSF, and we've got Andrew, who is John's brother. They set up a unit trust. They invest $400,000 each into that unit trust, so 50-50. And again, it doesn't have to be, I guess, there's those percentages. It can be whatever percentages you like. That unit trust then uses that $800,000 to go buy a property. That unit trust will then lease that property to a tenant, and then that tenant will pay the money back to the unit trust. And then at the end of the year, the unit trust will disperse the net income after expenses to the SMSF and to Andrew. Because it's a related party structure, you cannot buy residential property and then lease that to a related party, although you can buy residential property and lease it to an unrelated party. So moving on now, we'll move on to the unrelated unit trust example. So when we say unrelated, it means that the SMSF and its related parties hold no more than 50% of the units in the trust, and therefore it's considered an unrelated unit trust. When it's an unrelated unit trust, the unit trust can basically invest in whatever it likes, and it can also borrow. And this is the scenario we want to show you to you. If we just go to the next page, please. So we've got here, SMSF 1, 2, and number 4 there, SMSF 4, and then a fourth party there with 25%, which is not an SMSF. They're all unrelated parties. So in total, no one owns more than 50% of the units, and therefore there's no control. What this means is that this unit trust can buy a property and use gearing to do so. Jamie, with unit trust, because it's an unrelated unit trust and it can borrow, obviously it's not the limited recourse borrowing rules that apply here, but it's a standard commercial lending. So
it certainly is, it's standard commercial lending. So the bank would be lending to the unit trust itself. Obviously, the income that's coming through from the property would be used to service that level of debt. Any sort of deficit in relation to serviceability would come from the director's guarantee's personal position. So that unit trust, obviously, it may have a trustee, it's a corporate entity. The directors of that corporate entity would provide a guarantee. The bank would want to see the director's assets, liabilities position and income position to make sure that if there is a deficit from the rent, from what the loan repayment is essentially, to what the rental is that's coming through, that the directors or the guarantor position can cover that position from a servicing perspective. So that would service that loan. From an equity perspective, the bank would be looking to lend 70% against the property, which is standard commercial conditions. So therefore, the unit trust itself would have to come up with 30% plus the stamps to get into that property, which would obviously be, which in your diagram there would be coming from the self-managed super fund. So the fund's held within the 25-25, the individual that you've got there for 25, and the self-managed super fund to cover that 30% plus fees and charges to settle the transaction on the date.
A good example we have that is quite common with our clients is two clients that are in business together. They're not in a partnership. They're just essentially working in the one company. There's no control from each other. They're both 50-50. They want to buy a commercial property. They don't want to do it through an SMSF together. So what they'll do is set up their own SMSFs and they'll buy 50% of the units each into the unit trust, which means that they haven't breached that related party rule. It's unrelated. That unit trust can then go borrow to buy their warehouse, for example, or their factory. Or their office, which is pretty common with clients doing that.
Very common.
Moving on. So in the last scenario that we will talk about is borrowing to buy property via self-managed super fund, limited recourse borrowing arrangement. Essentially, what this is that your SMSF is establishing a separate trust structure, and it borrows and holds the property in that structure until the property is paid off. So in terms of it being limited recourse, it means that if the SMSF was to default on that property loan, if it had other assets such as shares or managed funds or whatever else it had, the bank would come after that asset. However, if my understanding is correct, the banks are getting personal guarantees
They are. Yep.
from members. So if you do
To the
fail
members.
on that loan,
Yep.
they'll come after you personally. So obviously, this is very common. It's something that Lee advises clients on quite a lot, and it has to make sense for the client and what they're trying to achieve. One thing to note is that sometimes I get a call from a prospective new client that says, I've put a deposit down on a property, I now want to set up an SMSF. So you have to set the SMSF up first, right? Then get your money into the SMSF, whether it be rollovers or your contributions, and then go find a property and buy it. So you've got to buy it in the right timeline.
Yeah.
So if that's something that you're considering, it's best to speak with someone before going to an auction and putting your hand up. And
it needs to be strategized, I
Yeah.
would say, to work out, that initial points that I was raising around does it make sense based on your personal situation?
Mm.
And then to get statements of advice, to set up the fund, there's a lot of work in that, and it generally takes a couple of months. So you don't want to be out looking for property, putting a deposit down, saying, oh yeah, I'll figure the rest out later. You want to get the ducks lined up at the start.
Definitely. And then what it looks like is you've got an SMSF. It takes out a loan from a lender. The trust is set up, which is known as a limited recourse borrowing arrangement. It holds a property, it's then leased to a tenant, and the tenant pays the rent to the SMSF. The SMSF is responsible for making the payments to the bank.
Correct. Yeah. So you're spot on there, George. So the actual loan itself, from a banking perspective, sits in the SMSF, or the trustee of the SMSF. The property is actually purchased in the bare trust, which is the limited recourse borrowing arrangement. So when you're coming to sign a contract to purchase a property, it should the actual purchaser on that contract will have to be the bare trust entity. So it's usually a company as trustee for the bare trust that makes that purchase. Yeah. So what then happens is the loan sits here. The property, the bare trust or the property trust provides a guarantee to the self-managed super fund, along with the personal guarantees from each of the members that are held in the trust. So they're tied into the loan as well. Effectively, the loan gets paid off over time. Once the loan is completely paid off within the self-managed super fund, the actual property moves out of the bare trust unencumbered and moves into your self-managed super fund, where it can sit as an unencumbered asset.
Correct.
So effectively, that's the reason and the purpose behind the limited recourse borrowing arrangement, or the bare trust, is to hold debt against that property, because you simply can't have an asset with any debt on it or encumbered sitting in your self-managed super fund.
Correct.
So hopefully that structure there is clear. I'll talk a bit around just the banking considerations that come with self-managed super fund lending or limited recourse borrowing arrangement. We do a lot of this at Blue Rock Finance, so it's something that we work closely with both Lee's team from a private wealth perspective, and of course George, obviously, who's guiding us and letting us know where we're sitting in terms of the SIST Act and making sure everything's compliant. So effectively, with any borrowing, whether it's self-managed super fund or outside of super fund, what the bank are looking for are two key aspects to make sure that a transaction is bankable. The first one is equity. So does the client have enough funds, in our case with the self-managed super fund, to actually cover the purchase of the property?
They also look for a cash buffer in addition to, don't they?
They do. Yeah, they do. So as Lee was mentioning in his previous slide, there should always be a buffer with every transaction you've got. There's got to be an element of cash that's left in the fund. And I think we spoke about repairs, maintenance, loss of tenant, all that sort of stuff. So the bank is looking for that. So equity effectively is the cash that's available within the fund to settle the property at settlement. Generally speaking, the bank, under a limited recourse borrowing arrangement, self-managed super fund arrangement, they will lend you 80% of the market value or contract price of the purchased property, whether that's residential or commercial. Now, that's different for commercial from a standard commercial transaction. Most standard commercial transactions, especially purchases over $1 million, a 70% loan to value ratio, so 70% of the market value. In your self-managed super fund, they're going to give you 80%. Right? So that means that you've got to have 20% in your fund, plus the fees and charges to execute on the property purchase, plus some liquidity at the end of the day. We don't want to run the fund dry. So we don't want to have to, we don't want $1 left in the fund once the property settles. So if you lose a tenant, you have to spend some money in repairs and maintenance, and you've gone over on your cap. Well, we can't get any money in the fund to back up the investment that we've just put in there. So that's particularly important. And the bank usually use a rule of thumb of 10% liquidity left in the fund post purchase. So of what was already in the fund from commencement. So that's a big one. So the equity piece is huge, and that's the first thing we sit down with our clients in relation to and discuss. Have we got the money in the fund to execute on what we want to do? And where does it look like? What does it look like? Can we buy a property at $1 million? Et cetera, et cetera. So the other key aspect is servicing the loan, being able to pay back the debt. The bank want to see that you have enough cash coming through into the fund via three means effectively. The first being the rental of the property that you're buying. It has to be for investment purposes. We've covered that off. Can't be owner occupied. You've got to be receiving a rental on that property. The second being the contributions to the fund. We mentioned that that's now moved from 25 to 27.5 per member per year in terms of concessional contribution. And then any other assets that are held in the fund that are generating income that aren't encumbered. So we can hold assets like your shares, other properties that have no debt against it, that are still generating income. We can utilise that income that's coming through to service the debt to the bank, to support to service the loan.
And I think, Jamie, based on my experience, is the banks, they don't want to just say, oh, you can put contributions in. They want to see some history, don't they?
They do, yeah. They
usually
the last 2 years. Yeah, so they're looking at what the last 2 years are. In saying that, we have done some transactions to say where the personal situation supports the 27.5. So we might have got, well, for example, I just recently looked at a transaction. The last 2 years were around 10K. We need the client to contribute 27.5 moving forward to cover the debt. So we've got some advice, and we've delved into their personal world in terms of what's happening from an income point of view through their business to say that, hey, they actually can make 27.5K moving forward.
Yeah.
Right. So the bank aren't hard and fast on it, but they want to see some history there that the contributions are being made to cover the debt that you're asking for.
Yeah.
And remember, the banks just aren't looking at covering the debt at the actual interest rate that we're seeing or quoting. It's the actual interest rate plus 2% over a 30-year period.
Yeah.
Right. And the 30-year loan period is a term that the banks use in the self-managed super fund world for both residential and commercial lending. So outside of self-managed super fund, the banks want to see you pay back a loan on a commercial property in 15 years. So they're giving you that extra tenure, that extra term in the self-managed super fund, which is an advantage as well.
That's great. Yeah.
So it's a cash flow thing, right?
Yeah. Exactly.
So your rentals coming through, your contributions are coming through, your incomes from the other assets are coming through. The money's there to support the transaction, plus a little bit more to keep the buffer going and diversify your asset portfolio. That's what we want to say.
Yeah.
And really, that 2% allows for that a little bit as well, that I spoke about in terms of the buffer that they have onto the rate.
And what's the latest on interest only versus principal and interest?
Yeah, so they're more than happy to do that. So you can go into an interest only arrangement for 5 years, commercial or residential. So you pay interest only for 5 years. As soon as the interest only period finishes, we can't restructure a self-managed super fund loan in any way, shape, or form. So it has to convert to the P&I, and it'll just do that over a 25-year period. So what that means is your actual repayments, instead of going P&I from the start, actually you're a little bit higher because you've gone interest only for 5 years and then you're covering the loan term, or paying back the entire debt over 25 years instead of 30. So just got to be mindful of that when we're structuring these sort of transactions, making sure it's feasible for the client as well. So some other considerations here, as you may not know, but a lot of the big four banks have pulled out of self-managed super fund lending. So you've got four major players in the market. You've got Liberty, La Trobe, Think Tank, and a couple of other second tier funders that we use, such as Wealth and Better Choice. So these are the guys where we're putting our transactions for. It is a little bit more expensive than your standard commercial lending, mainly because of the compliance and the audit and the requirements of the bank, plus the process around getting it all approved. Depending on, I've already covered off the 80% LVR. In terms of interest rates, We do see a sliding scale in terms of loan to value ratio. So the lower the loan to value ratio on against the purchase, the better the interest rate. The spread from a 40% LVR to an 80% LVR is about 1% difference.
Yeah, right.
So that's where
that's really just looking at the risk the bank's taking on. The higher the risk, the higher the interest rate.
Correct.
Yeah.
Yep. So in terms of loan terms, I've covered that. Lender fees, the fees are more expensive in the self-managed super fund world. There's more documentation. They have to peruse the self-managed super fund. More compliance checks. The Bear Trust have to make sure it's compliant with the SIST Act. From a commercial funding point of view, you're looking at about a 1% app fee in general on the loan amount, and it's a lot less on a residential. It's around $500 an application fee. As mentioned here, liquidity, we've already discussed that. Generally, the rule is 10%. A lot of some banks do have that requirement, some don't. The other thing that I wanted just to throw in terms of other considerations is when you purchase a property, it has to be a single acquirable asset. So it has to be on one title. Effectively, if you're purchasing a property with multiple titles, they essentially can't be sold separately.
So you'd be able to do it, but you have to have multiple loans.
Correct. Multiple bear trusts.
It's one loan per title, essentially, unless it's situations where those assets can't be sold separately. For example, an apartment. Sometimes you can buy an apartment in the city where that car park comes with it and you can't sell that car park separately. The bank will take it as one asset.
Yeah.
But if you can sell that car park separately, you'll have two loans.
Correct. Yeah, you're spot on there, George. So I'll give you a quick example of a transaction just in relation to as I think Lee mentioned before, we see a lot of our business clients or business owners purchasing the owner-occupied property and placing their business in and structuring a lease facility. So just in this example here, we've got a client that's got $500,000 in liquid assets held within their self-managed super fund. We completed a debt servicing analysis to make sure that the acquisition that they're looking at for $1 million, they could cover the rental and the contributions of the two members. So the rental, the contributions could cover the loan repayment at the affordability rate, which is the actual plus the buffer. In this example, equity-wise, it's $1 million purchase. The bank's giving them $800,000. The fees and charges are $55,000. So the client has to come up with $255,000 to get into the property, plus the fees and charges. The applicable rate on this transaction was around the 6.7%. So as I said, it's slightly higher than what you would see from a commercial point of view. Just to give you an indication, the bank bill swap rate at 90 days at the moment sits at about 3%. Most clients have a customer margin that sits anywhere from 2 to 2.5%. So commercial rates at the moment are sort of sitting at 5.5 from a standard lending point of view. So 6.7 is sort of 1% above what our standard rates are. There's valuation fees and then perusal fees. The security is a registered mortgage over the property. Obviously, they take a mortgage over the property, which again is just recourse or non-recourse to that property held within the super fund. The guaranteed indemnity given by the Bear Trust who owns the property, and a guaranteed indemnity given by the members of the super fund. So I've just got to note that the lender has no recourse to the self-managed super fund, only the Bear Trust and the individual members. So the recourse comes back to the Bear Trust, which just simply owns the property, and the individuals. It's a set and forget loan structure. We can't restructure it in any way. It's 30 years. Either you go interest only for 5 and then convert P&I for 25, or your 25, or your 30 years P&I into the loan structure. Here's just a couple of examples. I won't really run through these quickly, just in the interest of time, but what we're doing a lot of at the moment is we're seeing, as I mentioned before, the big four banks have pulled out of self-managed super fund lending. So what they do have is they have some legacy, some older loans still in the self-managed super fund space. And what we're seeing that they're doing with their self-managed super fund loan books is lifting the client's interest rates quite significantly because they don't really want to be banking these facilities. So what we've been able to do for a number of our clients is just refinance them out to these financial institutions, your Latrobe's, Liberties, your think tanks, that actually want to do these transactions at a much cheaper rate. So we are refinancing a lot of existing self-managed super fund loans, and we can do that as long as it's a dollar for dollar refinance, as long as we comply with the SIST Act and the Bear Trust and the self-managed super fund is legally ticked off. We're right to rock and roll. And they're offering some sharp rates and cheaper sort of transferring fees, which is good. So I won't go into the case studies there, but there's a few there. And really, that's really it from me. In summary, obviously, what we want to see you guys do is get advice, as it is a complicated area, self-managed super fund. The SIST Act, there's a lot of conditions that, to comply under the SIST Act. So the best thing that you guys can do is get your advice as early as you possibly can. Engage with, Lee and his team, Private Wealth at Blue Rock, engage with George and sit down and work out, is this the right strategy for you guys? Is there enough funds there? And is it the right strategy to buy a property within your self-managed super fund? So make sure the strategy is it complements other aspects of your holistical, personal, and super strategy. So it's got to be incoherent or working with your personal wealth strategy, which is what the guys sit down and do with all their clients. They're not only just looking at the super, they're looking at their personal wealth strategy, which unfortunately a lot of our business owners don't have time to do. They're so busy running their business. They come in and see Lee and we sort out their world and their personal wealth for them.
Yeah, and when we can work out that it makes sense, it's appropriate, it is honestly one of the best strategies to use. But we just really need to do that personal situation and identify that early on. And if it all stacks up, it's really good to go.
Absolutely. So making sure you understand the structures, taxes and risks, that comes back to George and his team and me effectively from the borrowing point of view. We do this we've done a lot of these self-managed super fund strategies and setting up super fund, whether it's to buy property or not. But we've got the expertise there to do it.
Definitely.
Yeah. Remember that the super money is your retirement nest egg at the end of the day. So you want to make sure it's the right strategy. It's got to be right? Because we're playing with your livelihood, your wealth, when you finish working and there's no money coming through. You want to really build that nest egg and then get it working for you from an early age. So we've got a couple of questions here I'm going to jump into just quickly from James. So thanks, James, for popping those in the Q&A. The first question that James has asked our panelists here today is it possible to buy an income-producing property, such as a caravan park or bed and breakfast, and use any dwelling on that property for supervision of property or maintenance?
So I'm taking that as if the caravan park is, land, you're buying land. So in essence, if you can buy land, there is an exception with farmland where it's within a specific amount of acreage where you can have the property on there and live in it while you run that farmland business. I'm not going to say yes for this one because a caravan park is a business and you're saying you want to have a property on there to live on for maintaining that. It's like leasing a residential property out of a caravan park to yourself. So the answer to that might be no, but happy to catch up after this to go through more details to understand your question to give you a better answer. But generally the answer is no.
So if they're living on the property, you would suggest no?
Yeah.
What about if they're not living on the property?
Well, they could buy the land and lease it and run it as a caravan park. If the caravan park was their business, then they could lease the land to themselves and run the business out of there.
Okay.
Yeah, I think a really important one there is if it's anything to do with superannuation, it has to be specifically for retirement purposes and there can be no personal use.
Yeah. Because you get access to the money, you shouldn't have any present day entitlement or enjoyment out of the asset. And, the commercial property being the only exemption.
Yeah, I think from a borrowing point of view, we might struggle on a caravan park or B&B as a specialised asset. So they may not be willing to fund in the self-managed super fund.
Probably not.
Yeah. The next one, if I buy a property as tenant in common with self-managed super fund, is it permitted for the non-super owner to borrow those funds externally with no mortgage on the property being purchased? How will capital gains be treated?
Sure. So, yes, you can have the SMSF pay X amount towards a tenants in common arrangement, and you personally go and use your personal house to pull equity out of that and use that equity to fund the other half, for example, of that property. And then in terms of the capital gains,
Yeah, I can jump in there, George. So, I would say, that whole tax structure piece that we talked about earlier, if half of the fund super fund purchases a property and the fund's in pension phase, you pay no capital gains tax on that, as long as that total balance is under 3.4. If it was in accumulation phase, then the rule works where you still get the 50% discount if you've owned the property for over 12 months, but then the super tax rate is 15%. So a really simple way to calculate that, if you're thinking about it, is the gross gain is about 10% is what the super fund portion would pay. And then from a personal perspective, it depends where that's owned. So if it's owned in a family trust, you can distribute to others. If it's owned in a personal name, it's just really the capital gain minus the 50% discount if you've owned it for over 12 months, as per other income in your name and marginal tax rates. Yeah.
Okay. Can an SMSF be tenants in common with a family trust? A quick question there.
Yes.
Yeah, beautiful. Do you need to meet requirements on buffer and contributions to the fund if it is a refinance of existing property owned by SMSF? Do you need to? Yes, you do. Yeah, they'll want to see that you've got some buffer there on a refinance, just in case, as we mentioned before, for repairs and maintenance, loss of tenant, etc. So it would certainly be looked favourably upon to have some sort of buffer in terms of cash, and you haven't bled the fund dry when you're looking to refinance that property with another SMSF LRBA provider. Yes. Next question. Sorry, I put this in chat instead. Is it permissible for an SMSF to purchase a commercial property that is yet to be renovated to become fit for purpose? Specifically, could my SMSF purchase a couple of high street shop fronts and then renovate them into units to rent as overnight stays?
Generally, yes. We need more information to answer that question, but I'm assuming this is without borrowing, because you cannot change the nature of an asset that you've bought via limited recourse borrowing arrangement. Correct. So if your SMSF is using cash to buy the commercial property and using cash in the SMSF to renovate those properties, to turn them into, I guess, Airbnb overnight stays kind of apartments or little houses, that should be okay.
Yeah. Excellent. That's it for today's. Yeah. Anything else, George? Sorry?
Just we have a comment here about the CGT discount SMSF is 33%, not 50%. That's correct. It is a third, and that was why we said 15%. From 15%, it goes to 10%.
Okay, excellent. Well, that's it for today's seminar. Hopefully, you've got a fair bit out of today. And if there's any questions or concerns outside of obviously what we've presented today, then feel free to reach out to George, myself, or Lee. We will obviously do a bit of a circle around after the webinar in terms of an email out to all attendees just in relation to our contact details. And if you have any further questions or concerns, by all means, reach out. And thank you for tuning in today. Appreciate it. Cheers. Thanks, guys.
See you later.
Bye-bye.